Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I want to discuss why I think that President Trump's tariffs could turn into a major positive catalyst for the REIT sector and ultimately lead to its recovery in the coming years, potentially richly rewarding investors who have the courage to buy shares of REITs at today's discounted levels. Towards the end of the video, we'll also highlight some of my latest top picks for today's rapidly evolving environment, so make sure to stick till the end. Finally, before I get started, can you please show your appreciation by clicking the like button, subscribing to the channel? It will help me a lot to keep producing this free content for you, especially as I'm still traveling and don't have access to my studio. Thank you so much in advance. So Donald Trump is a real estate mogul. We all know this. He's been in real estate investing most of his career. So was his father already. He's reported to have earned billions investing in real estate. And to this day, most of his net worth is tied to a real estate portfolio ranging from skyscrapers in Manhattan to hotels in Las Vegas, even land in Scotland. But while he's been very successful over the years, he has also had his fair share of setbacks in real estate investing, including bankruptcies of casino real estate in Atlantic City. And in many cases, his setbacks have been due to over leverage and not being able to handle the debt maturities and having to file for bankruptcy. And so he's very well aware of the risk of leverage and the risk posed of leverage, especially in a rising interest rate environment. And so with that in mind, he has several times over the past month and even quarters now tried to push the Fed chair, Jerome Powell, to lower interest rates. That would obviously benefit him personally for his real estate portfolio, but also benefit the US economy. The US has, I think it's $9 trillion worth of treasuries that need to be refinanced this year. That's very significant, and so lower interest rates will be more than welcomed. But so far, he hasn't gotten much in terms of rate cuts from Jerome Powell, and so now there are growing rumors that he might be attempting to intentionally cause some damage to the economy, or perhaps cause enough uncertainty for Jerome Powell to finally cut interest rates. And if that's truly his goal, perhaps he might achieve that with his latest tariff announcements. Earlier this year, the 10-year Treasury was at nearly 5%. After his first tariff announcement, the 10-year dropped below 4%. Since then, it has bounced back a bit. Now it's at 4.3%, but it's still quite a bit lower than in early 2025. And more importantly, the debt market is now predicting significant rate cuts later this year. There is a near 100% chance of a rate cut in June, according to the Fed Watch tool. And the highest probability is that we'll get 75 basis points or 100 basis points worth of cuts by the end of this year. And that would be huge for real estate investors like Donald Trump, but also for REIT investors like myself, because, REITs have been in a 3-year-long bear market now. And this is entirely due to the rising interest rate environment we've been in. It has caused the market sentiment of REITs to suffer because while REITs have strong balance sheets and overall they've done well, they've been able to grow their cash flow, keep growing their dividends. They have not been severely impacted from a fundamental perspective. It has still severely impacted the market sentiment because, when interest rates were really low, a lot of investors were buying REITs for their income as bond replacements in their portfolio, but as soon as they were able to earn decent yields from bonds and treasuries, they were quick to sell REITs and reallocate this capital to fixed income. And what this caused is that REITs then went into a bear market and they saw their share prices drop by about 30% on average. What I think will now then happen if interest rates are cut is the exact opposite. We'll see a lot of this capital from fixed income make its way back to the REIT sector, and this will lead to a sustained recovery in REIT valuations and richly reward those investors who have had the courage to accumulate shares of REITs during this bear market. Here, I know that a lot of you are asking yourself, aren't tariffs supposed to be inflationary? And yes, I would agree. If tariffs remain in place for an extended period of time, then inflation would likely take off from here, and this would likely prevent the Fed from cutting interest rates, which would be negative for REITs. However, I think that the more likely outcome here is that President Trump and his administration will now seek to negotiate an end to this trade war. They will seek some type of concessions, declare victory, and hopefully move on from this as quickly as possible with an outcome that's a win-win for everyone. Perhaps lower a bit of trade barriers and And so we'll move on from this, because at the end of the day, everybody's suffering from this trade war, including the United States. The United States perhaps could suffer even more than the rest of the world. And, if tariffs remain in place, we will see the economy deteriorate significantly. We will see inflation take off. And this is going to be extremely unpopular for the voters of Donald Trump, who elected him to lower inflation. And so I think that already now we've seen from President Trump some flexibility in quickly pausing those tariffs for 90 days for most of the world. And I think that he's again going to show this flexibility and seek a relatively quick resolution to this trade war in order to avoid this much higher inflation. And so I think the more likely outcome is that we will get a resolution. Inflation won't really take off because most companies won't materially change their pricing because of all this uncertainty. They want to wait to see how this whole thing plays out. And so I wouldn't expect too much inflation from it. However, I would still expect a recession regardless of what happens next, because this has already caused severe damage to the confidence of businesses and consumers. There's just too much uncertainty. And so this is leading to businesses delaying major investment projects. It's also delaying future hiring. Consumers also delaying major purchases. Let's say you were thinking of buying a house, but if you think that the economy is going to deteriorate, perhaps you'll wait a bit before buying that house, because you would expect housing prices to drop a bit. Or let's say you were planning to go on a major holiday, but perhaps you'll delay that to see what happens to the economy if you fear that you might lose your job. So I think that in any case, it will cause the economy to deteriorate from here. It's a really hard word for me, sorry. and so I think that the deflationary impact from worsening economy will be greater than the inflationary impact from this temporary, hopefully short-lived trade war. And so this then will give ammunition for the Fed to lower interest rates, and this will then lead to a recovery for the REIT sector. That's my base case scenario. I think that that's what's the most likely, and this will end up benefiting real estate investors like Donald Trump and REIT investors like myself. There's also another aspect of why these tariffs could benefit REIT investors, and it is that these temporarily high tariffs are now greatly increasing the cost of new constructions. And that, coupled with the high uncertainty, is likely going to put most new development projects now on pause. And that means less new supply in the coming years for most property sectors, and less supply means higher potential rent growth over the long run. It also increases the replacement values of existing buildings. So all in all, I think that if everything goes right, we could in the coming years see lower interest rates coupled with faster rent growth. And given that REITs are today trading at decade-low valuations, I think that this outcome could bring a lot of new capital to the sector and boost valuations to much higher levels, resulting in significant upside. And so with that in mind, I think that there are a lot of opportunities right now in the REIT sector. But still, of course, you need to be very selective because, as I mentioned, the economy is going to deteriorate. I think that some property sectors are more cyclical than others. In an earlier video, I explained that I'm not buying sectors like hotels, office buildings, mortgage REITs, billboards. There are quite a few sectors that are cyclical, but then there are some other sectors that are far less cyclical and are not really impacted by a recession or a trade war. Great example of that will be the healthcare property sector. And one REIT that I bought the deep lately is called Alexandria Real Estate. This is a REIT that specializes in life science buildings. This is a sector that's been facing some sector-specific issues lately because of oversupply. Because of that, it's priced at a decade-low valuation. This is the lowest valuation since the great financial crisis for the company. It's trading at just 8 times FFO. But it has a BBB+ investment grade rating. This is a recession-proof property sector. And over the long run, I expect a strong recovery now as the supply and demand slowly regain balance. That's one REIT I've been buying. I think it's not going to be impacted by this crisis and will greatly benefit from the lower interest rates. Hey, before I continue, I want to let you know that I just recently posted an exclusive interview with the CEO of New Lake Capital Partners at High Yield Landlord, which is my REIT newsletter. This is one of my favorite REITs at this time. It's offering a 13% dividend yield. It's recession resistant. It's not impacted by the tariffs. You can read the interview for free with our 2-week free trial. It will be the first link in the description of this video. Now back to the video. Another one that I like a lot is Kite Realty Group. This is a retail REIT that specializes in grocery-anchored, service-oriented strip centers. Again, I think that these are recession-proof properties that are not as heavily impacted by the tariffs as the market appears to think based on the crash that it experienced lately. I think that these are the type of properties that are very good inflation hedges as well. We saw that in the post-pandemic period when inflation really took off, these retail properties were able to rapidly bump up their rents and benefit from this higher inflation. So that is one REIT that I like a lot. There are many other examples. I think that Vesta REIT is one foreign REIT that could greatly benefit from this trade war, especially if you think that it lasts longer. This is the leading industrial REIT in Mexico. And the interesting thing here is that the tariffs placed on Mexico are far lower than the tariffs placed on China. And so I think that this could accelerate the onshoring process with a bigger portion of supply chains now moving from China to Mexico. I think that even if we get a resolution to this trade war, the uncertainty caused by it will make a lot of companies think twice about having major portion of their supply chains in China, and they will more and more of them will move that closer to the end market, to countries like Mexico, where even with a 25% tariff, it's way cheaper to produce goods than locally in the United States. So those will be three names that come to my mind right now. I also like net lease REITs. Net lease REITs have very long lease terms that protect them during recessions. A great example here will be VICI Properties. I just recently visited many of their properties in Las Vegas. They own casino net lease properties, and from here you may think that, okay, casinos rely on discretionary spending, so they could suffer in a recession, but that's not really the case in the case of VICI Properties, given that they have multi-decade long leases. I think that the average lease term is something like 40 years long, and the rents are pre-agreed for this entire duration with annual rent hikes that are often tied to the CPI. So if we get higher inflation, we'll get faster rent growth. And the worst possible crisis for a REIT like VICI was the pandemic. And yet, even in 2020 and 2021, every single one of their tenants kept paying their rent because these properties are truly mission critical for them. They cannot afford to default on their lease. And VICI was able to hike its dividend by, I think it was 10% in 2020, 11% in 2021, if I remember right, but very high single digit or low double digit. And so if in the worst possible crisis, VICI is able to perform so well, I think that if now we go into a recession that's triggered by the trade war, which is going to do just fine once again. So again, that's all I had for you today. To recap shortly, I think that hopefully what I think is the most probable scenario, we'll see a relatively quick resolution to this trade war. Hopefully that brings some long-term benefits to the economy, so it will turn into a case of short-term pain for long-term gain. That's at least how we will be sold the outcome of this trade war. But it's still going to cause some damage to the economy and give enough ammunition for the Fed to cut down interest rates without having inflation accelerate too much, thanks to a quick resolution of the trade war. And I think that this will be a very positive outcome for the REIT sector. And in that sense, I think that Trump might have given a gift here to himself as a real estate investor, but also to REIT investors. And this could really lead to a strong recovery in the coming years. Let me know what you think in the comment section below. Tell me also what REITs I should cover next. Thanks so much for your support, and see you at my next one. Bye-bye.